Hi, I'm Bob French. With the election coming up, we've been getting a bunch of questions about which candidate will be better for the stock market, Biden or Trump. But before we look at that question, I want to make a couple of points. First, the stock market is not the economy. Over the long term, the stock market and the broader economy are pretty well correlated, at least in a general sense. But in the short term, they can diverge pretty significantly and kind of do their own things. And remember, the short term can be a lot longer than most people think. Second, the president has a lot less control over the stock market and the economy as a whole, since I'm on the point, than most people tend to think. The president may be the most powerful person in the world, but they aren't all powerful. They certainly have more control over the market than you or I do, but they don't have that much control. The stock market is a massive and massively complex interconnected system, and we're all basically along for the ride, including the president. The last point before we get to the numbers is that who you should be voting for should be based on more than simply who will be better for the stock market, or even the economy more generally. Now, I'm not saying that these aren't important, or that they shouldn't play into your decision, but there are a lot of other issues that are in play here as well. So with all of that said, who would be better for the stock market? Well, rather than try and parse their economic proposals and suss out market expectations, and probably get everyone mad at me, I'll focus on what the historical data can actually tell us. We have historical returns for the S&P 500 index all the way back to 1926, closing in on 100 years of data in total. So we've got a reasonably good data set to work with. When we look at things through the lens of political parties, there's a pretty big divide here. The average return under Republican presidents was just under 9% per year. But the average return under Democratic presidents was just under 15% per year. And they also had a little bit lower standard deviation as well. Now, to be clear, this is a big gap. We're talking about an average premium for Democratic presidents of nearly 6% per year, along with less volatility. This is larger than the average return of either the size or value premiums, and is about 3/4 as big as the premium of stocks over bonds. 6% per year is a big deal. But I want to talk about how to interpret this premium, since it's a little bit different than the other premiums I just mentioned. Unless you want to try and argue that the premium for Democratic presidents is the market compensating us for fundamental risk, and you'd have to do some pretty interesting footwork to make that one work. Fundamentally, markets move based on new information, and specifically how that new information squares with what the market expected to happen. It's not as simple as the market went up because something good happened, or it went down because something bad happened. Rather, it's the market went up because something better than expected happened, or the market went down because something worse than expected happened. It's completely normal for the market to go up based on objectively bad news. The trick is that the news was less bad than the market expected. So the way to read the Democratic presidential premium is that the world outperformed the market's expectations during periods where we had a Democratic president by more than the world outperformed the market's expectations during periods where we had a Republican president. And I'm not going to touch the question of why that is. One other thing to consider is that political party is a pretty loose idea at best, especially when we're talking about nearly a century. It's an approximation, but it's the best we've got, and, well, we like our teams. When we're looking at the data, though, we need to remember that each president is their own person and each had their own unique set of issues to contend with. As an example, the first president in our sample, Calvin Coolidge, and the last, Trump, were both Republicans. To put it mildly, they had very different governing philosophies. If nothing else, Coolidge was known as Silent Cal. And I don't think anyone would accuse Trump of being particularly taciturn. And speaking of Coolidge, these premiums aren't determinative. Coolidge was the president in our period with the best average returns, even if we don't have a full term in office for him. During the period we have data for, the S&P averaged over 30% per year during his term. On the other hand, his successor, Herbert Hoover, also a Republican, is the president with the worst average returns. If you're interested in doing a deeper dive on these numbers, I've actually looked at them in a couple different ways in some past articles, which I'll link in the description below. But here's the thing. The market knows all of this. Nothing that we've talked about here is particularly novel analysis. There's some interesting trivia here, like the fact that Gerald Ford, another Republican, had the second best average returns. But we can't really profit from trading on this information. All of this is baked into prices already. Just like always, what matters is what happens next. And we need to build our portfolios based on the long-term, fundamental risk and return relationships inherent in the market. And that includes being invested during both Republican and Democratic administrations. There's a lot to consider when deciding who to vote for, but please, just be sure to do so. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this or any other questions that you'd like me to address, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.